Okay, welcome everybody. This is Kurt Frankenberg and my good friend Mike Chepka on the East Coast. Hello, Mike. How's it going?
It's going pretty well, Kurt. How are you doing today?
I'm doing well since somebody said that my cartoon was sexy. Who was that wrote in?
I apologize, ladies and gentlemen. Give me
First
one
name.
moment. Yeah, give me one moment here. I believe it was, scrolling through all the names. It was Greg. It was Greg Z, as a matter of fact, so.
Okay, well, thank you, Greg. Very good. Okay, well, hey, I want to prepare everybody ahead of time. This is a webinar that I've been cobbling together over the last couple of weeks, and just oh, it's a product of just getting to the end of my rope with a couple of things I see, so I don't have all the timing right, and Mike, you've never seen this before, so I'm hoping that it still turns out looking and sounding like a polished presentation, but if it doesn't, hey, can you cut me some slack? Can you forgive me? All right, Mike, this is called What They Don't Want You to Know. I think we actually had something go out that said what market makers don't want you to know, but it's not just the market makers. This is a pretty big conspiracy I'm wanting to unmask. And they say that whistleblowers aren't popular. I don't really care too much about that. I don't care about my popularity. But what I might be a little concerned about is the men in black. There's a couple of guys hanging around the office. And no, I'm just kidding, of course. I don't think my life's in danger for saying this stuff. I think a lot of you have already thought it. But I'm going to be real plain today and come out and say some things that may offend. I hope they don't. But we're going to be talking about options trading, of course, and why it's so hard sometimes to get a leg up. And Mike, are you looking forward to this? I'm looking forward to it.
I'm looking very forward to this. A lot of customers have called or emailed in when they received the emails that you sent out to them, and they asked me, well, what is Kurt going to be presenting? And I'm in the same boat with everyone here. I'm learning something new today as well. So this is going to be very interesting and very intriguing.
Very good. Okay. Well, here's what to expect today, everybody. I'm going to unmask a conspiracy. We're going to solve some problems here, okay, and provide some real steps for you to take in light of what you're going to know. Okay. So, Mike, I think you've probably heard or seen or one variation or another of this story. Do you happen to recognize this movie scene right here?
No, I must say it escapes me. Is this that new movie that came out about the geniuses that went to Vegas to try to tip things in their favor, or is this something else?
Yeah, it's actually not very new. It's been out a little while, but yeah, this is from 21,
That's it.
which is based on Ben Mesrick's book, Bringing Down the House, and it's about some MIT students that went to Vegas and cleaned them out, and things got a little interesting. Okay, I've been looking at these things in the bookstores and so forth, and I'm sure that you've seen this story. I've been to Vegas. I just came back from Vegas after being there for a week. I had just come back, and I was actually visiting my wife's parents. But folks asked me, how much did you donate? I said, what? How much did you lose? Did you go up there and did you play? And I said, yeah, I saw the tables, but no, I didn't play anything. I refused to play. Why would I want to do that? Something paid for all those lights. Something paid for those huge buildings, and it wasn't. It's not because they're there to give away free money. You understand?
Mm-hmm.
And there's these books out that'll tell you, geez, you can learn how to play cards and count cards and take away the market. I'm sorry, not the market, but the casino edge. They'll make it real cheap and easy for you to come in. Really cheap flights, really nice hotel rooms at a reasonable cost. Everybody's friendly. Everybody's having a good time, right?
And there are no clocks in the casino.
I've noticed that. There's no way to tell what time it is unless, of course, you take it with you. How does this stuff usually end, Mike?
Well, it usually ends. I mean, my friends up here, we don't go to Vegas as often, but we do go to Atlantic City, a similar prospect. And,
Right.
just 5 or 6 old friends taking a trip out over the weekends. And pretty much every time we say, well, that was a great trip, and we all made our donations. We made our yearly donations, so we're coming back with just, enough money to buy a coffee or Gatorade on the way home in the morning. So that's the idea.
Yeah. Yeah. Normally, what happens is oh gosh, they say that 80% lose and 20% win in most economic settings, but this is a hyperactive setting. This is an incredible machine for sorting money out of your pockets. The house has got to win. That's number one. It's set up that way, okay? Now, there are a few savvy pros that are going to be able to play the angles and really know their numbers and really stay on top of their emotions and play right, and they're going to win sometimes. They are, okay? But usually it's folks like you and me, Mike, and I told folks that, man, this might offend you. I don't mean to call you a patsy, but we've all played the patsy sometimes, haven't we? Okay, the losers are those that play against the house, the folks that want to try and beat the house. And I'm going to say maybe that's not the best way to go. Maybe it's not the best way to go to try and beat the house, because it's not going to work out for you. Here's a saying that Warren Buffett is famous for. He actually did not originate this saying. He was quoting a book that was written in 1970. Okay, but Warren Buffett said this at a stockholders meeting. He says, "If you've been sitting at a poker table for 15 minutes and you don't know who the patsy is, get up, because guess what?
It's you.
You're the patsy. If you haven't figured it out, if you can't point your finger and say, okay, that's the one that's financing everybody else for now." And then, of course, when he runs out of money and leaves the table, then somebody else is going to be the patsy. And that's really how it goes, okay? That's how it goes. I've got a student, Mike, as you know, I'm a mixed martial arts instructor. I've got a student that's a professional poker player. He's retired from his real estate, what do you call it, his business that he did with real estate. And recently he came back from Vegas with $110,000 in winnings. $110,000 in winnings. And he agrees with me on this. We've been talking about this. And you know what? If you're winning that from the house, you understand, if you're beating the house, you're going to end up having to talk to somebody unpleasant. Okay, so that's that. But let's get away from Vegas, and let's talk about options. Okay? Now, the market makers would be what? They'd be the house.
That's right.
Go ahead.
Yeah, I was going to agree with you. The market makers are going to be the house.
Okay. Would you agree that some savvy pros, some folks that play this game do come out ahead?
Sure. Yeah, we saw that.
Yeah, a lot of folks will come out ahead, okay, but a lot more are going to finance the other two, okay, and that's going to be the patsies. Okay, and again, I don't want to upset anybody. Patsies finance the players. I told you this might be offensive to some. Okay, we've all played the patsy. It's been me. Okay, it's been me at one time. I don't do it anymore. Okay, and there's no shame in it. Okay, unless you keep doing it, especially once you learn some things that'll keep you out of trouble. Why would you want to keep volunteering? Why would you want to still be the patsy? Okay. All right, so we're going to talk about conspiracy here, Mike. If folks are picking up your money, okay, are they the same people that told you how easy and fun and important it is? Did they push the right buttons, and did they get you to sign up, and did they get your money? Who stands to gain? Okay, who stands to gain? Mike, who stands to gain in the marketplace? The market makers are going to make their money, right? Okay. I'm going to say that seminar gurus make money in this game. Would I be wrong in saying that?
No, that's true. I mean, we've talked to a lot of customers over the years who've paid $3,000, $4,000 to take a weekend seminar to learn the basics of how to trade a certain strategy. They might have been promised gains of 3 to 6% per month, or using leveraged spreads 12% per month, but the downside and the risks aren't addressed. Most of those customers come out saying, well, we paid $3,000 to do this, and I'm down $6,000 after my first 5 months of trading. It's where am I going? Where's my 3 to 6% per month?
Mike, you just about summarized 50% of my presentation day. You did. The make you brokers, okay, the folks that are doing the brokers, you know who else stands to gain? The companies that have optionable stocks.
Mm-hmm.
You know, it can't be liquid and it can't be as easily traded unless there's a lot of volume, unless there's a lot of people out there, buying maybe things they shouldn't buy. Okay, so Mike, I'm going to talk about just one aspect. Okay, I'm just going to pick on covered calls. There's also spread trades out there. There's long calls and puts. I mean, there's all kinds of different strategies. Okay, I'm going to pick on covered calls here in just a minute. You know what? First, I think I better ask what everybody else is doing. Okay, so let me just pause for real quick, and this is a shorter poll than usually we'll put up there. We'll usually put up 5 different things, that you can choose from. I'm just going to say, look, what are you doing now? And I believe that this is something that you can choose more than one. Okay, so if you're doing more than one, like if you do covered calls and you do spread trades, or if you do long calls and you do covered calls or long puts, okay, go ahead and plug those all in. Mm-hmm. Plug in everything that you're familiar with and that you're using, that you like, maybe that you don't like. And here in a minute, I'm going to be picking on covered calls. It's pretty close here, Mike. We've got a lot of folks doing a lot of different strategies. We've got spread traders ahead right now. We've got several hundred have already cast their votes. Let me go ahead and close that poll and share the results because it's been a minute. Okay. All right, Mike, in first place, we've got spread trades. Second place, long calls and puts. Last place is covered calls and naked puts. And it's probably because this sounds like a savvy audience. It's probably because some of y'all are migrating from that first thing that you did. What do I like to call covered calls, Mike?
We refer to it as the gateway drug. And usually if you apply to trade options, you'll get level 1 trading. It allows you to do covered calls and naked puts there. So it's the starting point. And it causes some investors issues, and we're going to take a look at those, I believe, in a little bit.
Yep, you'd be right if you thought that. Let me see here. I am going to say, I'm going to ask how's it out for everybody so far, okay? And then we're going to get into a search result. When I plugged into Google, I plugged in this question: are covered calls really safe? That was my question that I plugged into Google. And I think you're going to be really amazed at what came up. Okay? And of course, I'm asking for folks that, not folks that just bumbled out of the seminar or just completed their home study course, and or a friend just took them by the hand and they did one good play. Okay? Mm-hmm. I'm talking about if it's been 12 months or more that you've been trading that strategy that you just told me about. Okay, if it's been 12 months or more, tell me how you're doing. Tell me how you are doing with that. And Mike, it's looking about the way it normally does. In fact, yeah, this is kind of disappointing. Let's give it about another 5 seconds. And if you haven't cast your vote, please do. Remember, we're going to have fun today. All right? Mm-hmm. That's why I started with a cartoon character. I wanted to have some fun. All right, 3, 2, 1, let's go ahead and close that poll. I'm glad that some more folks come in. At one point, it was single digit. It was like 9% saying, yeah, I'm doing great. Okay. But then 55% say not great. I'm ahead, but I'm disappointed. And then 33%, not even good. They've lost money. They've lost money. Now, Mike, and unless I'm wrong, gaining 3 to 6% per month should not mean a net loss, right?
Very true. I should be very positive if I'm gaining 3 to 6% per month. Isn't that right?
That's right. Okay. So here's the question that I put into Google. Okay, and it could have been another question. It could have been something like, can spread trades lead to financial independence? Or can long calls put you on the map financially? Well, here's one that I put into Google: are covered calls really safe? You'd be amazed at what I got. First of all, the second result was an article back from April of 2009. It says buy right, which of course we know is another word for cover call. Safe harbor in troubled times. and then makes this assertion: call options are usually overpriced. Those that sell them tend to make more money than those who buy. Now, Mike, is that an assertion that's based in fact? What do you think?
Well, one could say that doing a buy right, people, if you take a look at the buy right, over time, someone who does a buy right is going to generate more premium than those who just buy straight stocks. There might have slightly less losers as well, percentage-wise, because someone who just buys a stock outright, if the stock falls 20%, they lose 20%. But when I do a covered call, if I buy a stock, sell a call against it, generate my 3%, I'm still on the hook for 97% of what I invested in the position.
That's right. And so, and you would have to be covered in order to collect that. If you weren't covered, Mike, would you say that this statement is still true?
Absolutely not. If I'm doing naked calls, I'm still taking on a significant risk, not on the downside now, but on the upside. It's theoretical infinite risk on the upside if I'm just selling calls without owning stock or another call as part of a spread position.
Right. Now, this is the second result, okay, in Google. And here's another portion of the article. Selling covered calls continues to generate big, safe income. Okay. Now, Mike, look at the date on this one by Jeff Clark. This was the third Google result. August 28, 2008? Are you freaking kidding me? Look at this, what he says. Our cover call is really safe. He says, it's the best kept secret for safe double-digit income. Cover call writing is the single best income-producing strategy ever created. Okay, it was true 11 years ago. It's true today. I bet it'll be true 10 years from now, but not many people have heard about it. Wow. That's something else. Here's the fifth Google result. We come up with a fellow's site named John Brasher, callwriter.com. John Brasher asserts, is a 5% monthly income from covered calls writing really possible? What do you figure he said, Mike?
Well, if a customer asked me this question, I would say, yes, we can find positions using the patented Power Options tools that are covered calls that might yield a 5% return. Are you guaranteed that you're going to get that? Absolutely not. Are you guaranteed you're going to keep that and do that consistently month by month by month? Absolutely not.
Right. The word monthly implies that it is month by month by month.
Exactly.
Okay?
Mm-hmm.
Yeah. John Brasher says the answer is an unequivocal yes. Unequivocal means I have nothing else to add.
Mm-hmm.
I don't need to tell you that you might only get it 1 month. I don't need to tell you that you might also lose 20% of your capital that's in that trade if the stock goes down. I don't need to tell you that. It's just unequivocal. Unequivocal yes. Okay? Well, let's find out more, Mr. Brasher. How do I begin? Well, first, request our special report on how to make 3 to 5% in almost any market. I'll give it to you free. See, this sounds a lot like when I go to Vegas and they want to hand me pamphlets telling me how to bet, telling me how to do blackjack, how to do poker.
Mm-hmm.
And these are really slick materials, really nice. Okay, how safe are they, Mr. Brasher? Are cover calls and stock option trades really safe? I think this is why this showed up number 5 on the Google results, is because of this entry on that web page. The question is there, and the answer is covered call writing is widely considered one of the safest and most conservative trading strategies available. Now, Mike, that is true, isn't it? I mean, it is widely considered one of the safest and most conservative.
I would agree with that. If you look at your broker, or you look at anyone who you're trading with online today, if you take a look at your broker and look up covered calls, they might have a graphic that shows that covered calls is safer. Well, it might be considered safer than buying straight stock, but overall, it's still not a safe strategy.
Right. It's still not a straight strategy. How about this widely considered? If we took that out, would this still be a true statement? Covered call writing is one of the safest and most conservative trading strategies available. Would you agree with that?
No, I would not personally.
Okay, and that's based on how many years of teaching folks how to trade out? You're the director of options education over at Power Options.
Yes.
That's based on how many years of you counseling folks that are trying to squeeze money out of covered calls?
8.5 going on 9, sir. And I traded covered calls myself for about the first 15 to 18 months when I started here at Power Options.
Look at what Mr. Brescher goes on to say. In fact, covered call writing is the only option strategy the U.S. government wants you to do in IRA accounts.
Mm-hmm. That's true.
Mike, are you breaking the law?
No.
I mean, you've got an IRA account, yeah?
That's right, yes. I have an IRA account at Fidelity where I employ most of my radioactive trading positions.
Okay, so you do nothing in there but trade cover calls. True or false?
False.
False. Okay.
Mm-hmm.
So you trade long puts, long calls, you trade cover calls, you buy stock.
Yeah, combinations need to be considered collars. That's right, exactly, Kurt.
Okay. All right. So I'm just trying to, what we're seeing is factual. Okay. All right. Mike, the radioactive trading site actually got in trouble for talking about put options and the extent to which they can protect you and keep you out of trouble. It's in the consumer's best interest. But those pages we had to make dramatic alterations to. And there's nothing in there that was outlandish or obscure or anything. But let's take a look at one of the top rated. This is compound stock earnings. Now it says I'm just taking this from the page. Compound stock earnings was founded in 1999 by a former broker and bank owner, Joseph Hooper, in response to a genuine need to educate the ordinary investor about the merits of covered calls. Okay? All right, now let's look at some of these statements. Correct application of the covered call techniques allows the generation of consistent monthly income from a stock investment. Okay. Mike, have you seen anybody that has consistent monthly income from a stock investment?
Well, I believe the gentleman that you're referencing here shows that on his site, but some things that aren't discussed, and I've heard this as a counter, is that, well, it doesn't matter if you're doing covered calls in your portfolio. You have a covered call portfolio and your stock is down 20 or 25%, or two of your stocks are down 20 or 25%, because you can still sell calls against them and generate income. So you don't care if the stock's down 20%. I'm sorry, but yes, I do. My account is down as a whole. I have two stocks that are down 20%. My overall portfolio is down. If I can still sell calls against it, yes, maybe I'm generating 1.5 or 2% of income, but my portfolio as a whole might be down 30%. That's not where I want to be at all.
That's right. Now what's being suggested here, Mike? This income can be used for living expenses in retirement. Wow. Okay, so if I'm just learning about covered calls trading and I've got $500,000 socked away from my retirement and I put it into stocks and expect to live off of the calls that I sell against it, Mike, would you advise that course of action for anyone?
No, I would not.
Not even your mom?
Not even my mother. My parents actually, they're my father's about 71. My mother's about turning 70 this year, as a matter of fact, and they have an advisor that they use out in Nashville. And I sent him a copy of my book on protective option strategies, which is just an introduction to using collars and married puts. It's not even close to what the blueprint is. And he was so impressed by it, he says, well, wait, how can I use this for your parents? And I said, let me tell you about the blueprint, and let's see what you can do with my parents' account using that.
Wow. I'm flattered, Mike. I didn't even know that. That's really cool. Here's the next statement. It can be reinvested on a what?
Regular basis? Monthly basis?
Monthly basis. I would say month by month by month. Monthly basis to dramatically compound the value of a portfolio. Look, guys, I am not making this up. Okay, I'm not doing anything but showing something that's already out there. And it was pointed out to me, well, Kurt, you can't always, go by that. I mean, that might be something that was put up there in cyberspace a long time ago, and since then, they've changed it. And okay, so here's a press release. This is just a few days ago. Indeed, Compound Stock Earnings Program is not only conservative, but it is guaranteed effective. This is Joe Hooper in a press release. Mm-hmm. It's guaranteed effective, Mike. All right, happy day. And then also in the press release, it appears as though it's a reporter. According to Hooper, those who utilize the strategy effectively can generate a 3 to 6% profit on their stock portfolios every month, regardless of market fluctuation. Okay. Wow. Mike, I think it's time to hear from our audience. Okay. Covered call sellers only. Only folks that are doing covered calls. I mean, I'm not saying that that's your only strategy, but consider only that part of your strategy. Okay. That you answer this with. And if you've done it for, some time. Do you make 3 to 6% profit? Now, profit, Mike, is a really interesting concept.
Yeah.
Profit means that, I'm a businessman. I own a martial arts studio, okay? If I'm paying more in rent and salaries than I'm taking in tuitions, then I don't have a profit, okay? So we are talking about profit. If you're going to, you shouldn't say premium, 3 to 6% premium. That would be fine. But I'm talking about 3 to 6% profit. Okay. If you make 3 to 6% profit per month, I want to take your course, baby. Okay. So, Mike, we've had that pull up there for nearly a minute, and we've had a lot of our audience members participate in this. So we had a lot of folks doing cover calls. Let me close it and share the result. Okay. So surely in a weekend course, or at least in the advanced course, we would be able to figure this out, right? Mike, are you seeing the poll results? Can you see it up there?
Yes, sir, I am.
Okay, how many are doing the 3 to 6?
Well, 4% say that they make that every month for 12 months or more.
Okay, in the last 12 months, I could see that it may have worked out for some folks. I can see that it may have worked out for some folks. 3 years or more, nobody. Okay, 43%. Sometimes I make 3 to 6%, but it's nowhere near consistent. Wait a minute. It says every month, regardless of market fluctuation. So these guys must not have gone to the real course, right? Okay, 36% no, have heard of folks doing it, but have not seen their account. And 16% say, dude, my account is down since doing covered calls. How can that be? We're making 3 to 6% a month. I don't know. Okay, so Mike, hello. It's simply a matter of looking at the numbers, says Hooper. Our method comparatively low on risk, but it yields big results. Okay, and if you want to pick up this press release, it's here on this link. Okay. All right. We just took a poll on the results. I don't think that we've got a lot of folks that are happy with that. Okay. All right. So let's move along. All right. Here's my good friend Albert Einstein. He said that compound interest is the 8th wonder of the world. If we truly could get 3% per month, that would be, well, 40% year over year. Okay, if it's consistently generated every month, regardless of market direction, reinvested to dramatically compound the value. These are not my words, okay? These are the words that are allowed to be out there. All right. That's 40% year over year. If it were 6% per month, Mike, it's 100% gain, doubling your money year over year. All right. Did we see that in 2008?
Probably not, Kurt.
No. Okay. All right. So here's my challenge. Show me the money. I want to see something current. Okay. Mr. Hooper may have something on his site that says want proof, and the want proof is some income statements from I think it's April of 2005, and that's all that we can look to. Okay, so why doesn't anybody say anything? One of these gurus invoked the U.S. government, saying that the only options trading strategy it wants us to do is covered calls. Okay. Another former bank owner says it's guaranteed effective. Mike, I don't think you can say that about any strategy. Can you say that about any strategy for investing in the stock market, that it's guaranteed effective?
No, there really shouldn't be any guarantees discussed in the market. And we do suggest one thing. We do have a guarantee in one thing with the radioactive trading positions. But guaranteed effective is a tough one to swallow.
Right. What do we guarantee? Well, I'll guarantee that you can't lose more than a certain amount in the time frame. If you buy stock and also buy a put, I'll guarantee that you can't lose more than a certain amount in that time frame if you don't mess with it. Okay,
Hmm.
that's it. Well, Google should even deal with this. Okay, the government should deal with this. All these folks that are supposed to protect and look out for us. Okay, I think they're complicit. I think they're complicit. Everybody showing up in these search results has something to gain by you believing that covered call selling is safe, it yields a consistent income, and it can be used to dramatically compound. And everyone that goes along with this snow job is complicit. I've said it. Okay. Now I'm looking over my shoulder for the guys in the suits. Okay. Well, that's enough of us talking about the problem out there. I'm going to ask, what is your problem? And I'm not trying to be confrontational, okay? But I'm going to ask, guys, if you weren't 4%, we had 4% of the audience say that in the last 12 months, yeah, I made 3 to 6% every month. Okay, all right. If you weren't part of that, and 0% did that for any respectable period of time. 0% did it for 3 years or better. Okay. If you're not super happy, what does your guru say? What is the problem? Do they say, well, you're just doing it wrong? Okay. Or do they say, well, it's your psychology. You're doing it wrong. Okay. Or you need to fix your personal issues. Or, just keep being patient. Keep working at it. There's a learning curve to this. Or, you know what? What you really need, since you've gone to our $3,000 program, what you really need to do is go to the $5,000 program, because that's going to really fix things for you. Okay. Or do you have no support at all? All right. Let's leave it up there for just a few more seconds. 3, 2, 1. So close it and share it. And okay. So this was one of those polls where you could choose more than one, so the total is going to end up more than 100%. 15% say you're doing it wrong, plus you're in trouble for asking. Have you ever heard of any seminar like that, Mike?
A few out there where if you ask a question about it, you're more or less dictated to about how you're not following the correct procedures, or the reason you're in trouble is because you didn't follow the rules specifically.
Oh, okay. And then, of course, I think the biggest return here is, well, you need this super duper seminar, summit coaching program. You need something more than what you got for the initial $3,000 or so. That's what's called bait and switch, Mike. Where they say, hey, look, you know what? Here's something that's a real good solution for you. And then when you find out later on it's not, hey, you know what? We gave you a part of it, but what you really need is this other part that costs so much more, and we're willing to give it to you now. Okay? To me, that's dishonest. Okay? And I'm just going to come out and say it, and it's going to make me unpopular, but I'm saying what's on everybody's mind, I think. Why hasn't this problem been solved yet? Well, here's another table at which you might find a patsy, okay? They say cut losers short and let winners run. What I'm going to do is we're going to go into this, and I'm sorry if I'm just sticking it to the covered callers here, right? You can apply this to a lot of things. Later on in the same presentation, we're going to talk about spread trades, and actually how to do a spread trade that has zero risk, but pays you. Okay, we're going to actually show 2 spread trades like that. All right, but for right now, let's just take a look at the players in the covered call situation. There has to be somebody on the other side of every trade that you make, right? So we have the covered callers. Yeah, exactly. So I'm not sure if I've got you there, Mike, because you're typing furiously. But we've got the covered call sellers, right? On the other side of that covered call seller is the guy that's picking up the call, right? And in between the two of them is the market maker. And this is a grossly simplified approach here, right? This is very simplified. But what I want to do is I want to talk about how it's the patsy, it's the one at the poker table that finances everybody else until he has to leave. okay? And then we're going to look at this table here in the stock market, okay? So Mike, here's our situation. Everybody starts with $100,000, okay? Your stock is valued right now at $50, and the $50 calls are bidding at $1.80, and they're asking at $2. So are you with me so far?
Okay, I've got it so far, Kurt. 180 by 2. Let's start with $100,000, okay?
Okay, so if the covered call seller is going to play at this table, what he's going to need to do is pick up, using his $100,000, okay, he's going to pick up 2,000 shares of stock. Okay, so 2,000 shares times 50 equals 100,000 invested, right?
That's correct. Mm-hmm.
Okay, and then he's going to be able, because he has 2,000 shares, he's going to be able to sell 20 calls. The 20 calls he can sell for $1.80 because it's bidding at $1.80. All right, and it's a pretty big order. All right, so that's that side of it. Now, on the other side of it, we've got to have the long call buyer to pick it up. Now, what do they say about long calls, Mike, as opposed to buying stock? Preserve something or another.
Well, you preserve capital because you're using a leveraged position. You're not putting up the full price to buy the stock, so you can get higher percentage returns.
Right. Now, I'm going to say that it's only responsible for the long call buyer to have some cash on deposit, okay? Because that's, after all, what the call option itself presupposes. It presupposes that you do have the cash to buy the stock, and instead you put that cash into an interest-bearing account, and then you use a portion, just a small amount, to buy the calls. So I'm going to say that this long call buyer is using responsible money management. So he's going to take only $3,600 of his $100,000 and buy 18 calls for $2. So, Mike, how much of his capital does he have at risk?
Well, of his capital itself is $100,000. He's risking 3.6%, right?
Right. That's as much as he can possibly lose. Right? Okay, so here we go. So the long call buyer has spent $3,600 for his 18 calls, and the covered call seller has picked up that $3,600, right, by selling 20 calls. Now there's a little bit of a disconnect here. Do you see what's missing? Not everybody's going to pick it up. I think you probably will.
Well, the covered call seller has picked up $3,600, and the long call buyer spent $3,600, but the long call buyer is risking 100% of that $3,600, and the covered call seller is still risking, about 96% of the rest of the investment.
Right. But what I'm looking for is that the covered call seller has sold 20 calls, and the long call buyer only picked up 18 of them. Where do those other 2 calls come from or go to? Introducing Mr. Market Maker. The market maker, everybody sitting at this table is bullish. Okay, this is akin to everybody at the poker table thinks that they have the winning hand, right?
Yes, that's true.
If everybody at the poker table thinks, okay, I have the winning hand, and they're all betting the same way, every single one of these guys is bullish, aren't they? The long call buyer is bullish. A person that invests most of his capital in stock is definitely bullish, so that's the covered call seller, right? And the market maker, in this case, is going to be bullish too. He gets 2 calls for free. And the reason that he gets these calls for free is because of this bid-ask spread. You see, there's a 20-cent difference between what he sells them at and what he buys them at. So every 9 times that he does this transaction and sells, moves a call from a seller to a buyer, he picks up the 20 cents different. Now, every 9 times that happens, he's able to buy a long call free, right? Not really free, but he buys it for money that he's earned just by being a market maker. Okay, so CW down here stands for covered writer. All right, I wanted to make it so it wasn't CCLC and MC Hammer. Okay, so we've got CW, call writer, sells 20 at $1.80. The long call buyer buys 18 at 2, and the market maker, I'm not going to say that he buys it, but he owns it. He owns 2. It's like in his inventory, and there's a 0 cost basis because of all these transactions, okay? So these are the 3 people sitting at the poker table. All 3 believe they have the winning hand, and guess what? They do. They all do. They're all going to win. The stock goes to $55 a share. So the $50 calls are worth $5 on expiration Friday. Therefore, the covered call writer is obligated to deliver his stock, right?
That's right. Yes, and the stock's above that price. We're going to have to be assigned at 50, or put more money in the position.
Yeah, or buy the call back for $5, all right? But he sold the call for $1.80, so that would be unwise, all right? So here it is. The covered writer sells his stock and keeps his 3,600, okay? Now the long call buyer sells his 18 calls at a $3 profit. You see, they're worth $5, and he bought them for $2, remember, in the previous page? Okay? So he's done a little better. He's done a little better, okay? And then the market maker only picks up $1,000, and I say only with tongue-in-cheek because how much did he have at risk?
Essentially zero, didn't he, Kurt?
Right. So it's an infinite rate of return. Infinite rate of return. And it's only limited by how many transactions he can process. And oh, by the way, the more folks that believe that buying long calls is a good strategy, the better for him. And the more people that believe that selling covered calls is a good strategy, the better for him. Mike, would you say that the market maker is complicit in this scheme, this deal to try and get more people at the table? I would say yeah. Okay.
Yeah.
Well, everybody wins. Yay! Let's do it again. All right. So, Mike, what if we all took our winnings and we did the same play again? All right. So the covered writer sells 20 calls. You know, he buys a different stock that's $50, or maybe the same stock is moved back to $50. So it's at $50. All right. The covered writer sells 20 calls. Long call buyer buys 18, okay, and the market maker owns 2 with a zero cost basis, and then this time the stock goes down. Okay, the stock goes down $45. Well, everybody's going to lose. The long call buyer loses $3,600, right? The market maker loses, but what he loses costs him nothing, so essentially he loses nothing except for his time, right? Now the covered writer, right, the call writer, keeps his $3,600, but Mike, what about the value of the stock?
Well, it's down more than the premium he received from the calls, of course.
Oh yeah, okay. The stock took a $5 loss, and $5 loss times 2,000 shares equals a $10,000 loss. So, Mike, this is a zero-sum business, okay? This is a zero-sum deal. After all the trade is complete, the long caller made $5,400 on his winning play and lost $3,600 on his losing play. Is he ahead? Let's just look at him. Is he ahead?
Well,
I'm sorry, if he makes $5,400, and yeah, if he makes $5,400 on the first play, that's profit, okay? That's not his calls were worth $5,400. That was the profit we showed, okay, with 18 calls, and they went to $5, and he made $3 profit on each. $3 profit, 18 calls, he made $5,400, and on the second play he lost $3,600. So, yes or no, is he ahead?
yes.
Okay. How about the market maker? Is he ahead?
Well, yes.
Yeah, he makes $1,000 every time somebody trades 20 calls. Every time 20 calls get traded, he makes $1,000 and he loses nothing, and that's if he reinvests. Okay, but what about the covered writer? He makes $3,600 on the first play and loses $6,400 on the second play. Is he ahead or behind after the 2 plays?
Well, he's at a loss now.
Right. Okay. Now let's look at how this works. The covered writer picked up the $3,600 that the long caller lost. All right. And the long caller and the market maker picked up the $6,400 that he lost. You see that right there? $5,400 plus 1,000 is suspiciously like this amount that the covered writer lost. How about that? How about that? Okay, so that's what happened at this table. Okay, my conclusion is that in this particular case, the long caller was the savvy pro, the market maker was the house, and the covered call was the patsy. Now, I'm not suggesting, please don't understand and get offended. Okay, I'm not suggesting that everyone that sells a covered call is a patsy. Mike, you've seen me sell covered calls this last several months, right? You've sold covered calls, right?
Right, but done in the context of a protected position.
That's right. It's who we were at that table. It's who we were at that table. Does that make sense?
Mm-hmm.
But at this table, the patsy was the covered call seller. Okay? All they needed for everybody to make money was somebody to agree to take less on the way up, right, and to risk more on the way down, and that's how everybody here made money except for the covered call seller. Okay, so that's kind of the deal. Okay, all right, now I'm going to tell you why this was possible. Okay, the one retail player was willing to make 3.6%. That's the covered call seller. The other was willing only to risk 3.6%. So when he was right one time, he was able to allow his winners to run.
Mm-hmm.
And when he was wrong another time, it was cut and dried. He couldn't lose more than 3.6%. Okay? This principle of cutting your losers short and letting your winners run, this is what's responsible for the folks that continue to stay at the table. And I can't emphasize that more than I already have. Okay, all right. What did you not know was possible? We're going to share that here in a minute. Let me just take a look here at our polls. Oh, good. Okay, I just wanted to make sure that we had something queued up here. What did you not know was possible? Okay, it's not that selling covered calls by itself is a bad idea. It's just the way that this fella structured it. Okay, he had too much at risk. Out of that $100,000, in order to make $3,600, he had to invest $100,000. Right?
That's right.
The long call buyer structured his account well. Now, Mike, is it possible that if the long call buyer was sitting at that same table and he bought more calls than he should have,
Mm-hmm.
is it possible that he could have ended up hurt?
Sure. What if he leveraged himself entirely and bought $100,000 worth of long calls at one point or another? Where would he be?
Yeah, on the losing trade, on the second trade. Maybe that first trade emboldened him, and so he said, oh, my goodness, you know what? That was great. I made $5,400 profit. I'm going to come back and do that again, only I'm going to swing a bigger line. And so he puts more into it. Well, he would have gotten hurt. Okay? So it's about structure. The long call buyer structured his account well both times. So when he won big, right? And when he lost small. But if he had bet everything, he would have lost everything. Okay? So what we need to have, Mike, is a structure, a position of strength. And that's where we begin. From that position, any move can be advantageous. For example, I told you I've done some covered calls. Recently I've sold covered calls on Herbalife, right?
HLF,
well, yeah. It was never to my disadvantage. It was always something that's like, well, if I get called out, I will make a profit. And if I don't get called out, I'm protected on the downside. It's kind of cool, all right? If we have a good position, any move can be advantageous or at least have minimal risk. Even selling covered calls might work, all right? But I want to point something out here about the covered call and then compare it to another strategy that's also bullish, okay? Mike, we've got the market outlook as bullish. If we're going to buy stock and sell a call against it, or if we're going to buy stock and buy a put to protect it, it's still net bullish, wouldn't you say?
That's exactly right. We're expecting the stock to move up in price with both the protective put and the covered call to maximize the profit.
Right. And this isn't my propaganda, by the way. I'm putting up stuff that my broker has on their free education area. Okay. I'm putting up these images from there. Okay. So it's the same outlook. It has the same riskiness rating, although I don't agree with it. I would say that with the protective put, your risk is way over on the left, towards safer. And that with the covered call, it's more toward the middle. What do you have to say about that, Mike?
Well, again, when we say that the semantics of it, when you say, a broker says, excuse me, that a covered call is a safer technique, well, yeah, it might be safer than owning straight stock. But when you break it down to it, as I mentioned before, if I buy a stock, sell a call, generate 2 or 3%, I'm still risking 97% of what I invested. That's pretty risky to me.
Yeah, and of course we don't get to participate on the way up. Okay, that's kind of what really bothers me here is at that table that we just looked at, the covered caller didn't do as well when the stock went up, and for that reason, when the stock went down, he had a net loss between two trades. If he'd have been able to have an unlimited upside, it would have been very different. Would have been very different. So here's how I structure things. Now, Mike, I want to talk to folks about the value of cutting your losers short and letting your winners run, but doing it in such a way that you're kind of forced into it. You're made to do it. And I'm going to compare two trades with the same stock, okay? Within the last 12 months, I played Altera Technology twice. The first time I made 12%, okay? Although the stock only went, the stock went up 17.3%, I only made 12, and that's because of buying a put option, okay? All right, now the second time I played, I lost 5.6%. Although the stock went down in the time frame that I played it, it went down 21.8%. Okay, and it actually kept going down. It went down to 31% loss on the stock from where I bought it. But if I had gotten out there instead, well, my loss would have still been just 5.6%. Okay, so that's kind of exciting. The reason that this is exciting is because, Mike, if the stock goes up 17.3 and goes down 21.8, have I made progress, yes or no?
Well, if you make 17.3, Kurt, and we lose 21.8, we're going to be behind, aren't we?
Right. But in the same time frame, what actually happened is I made 12% going up and lost 5.6 on the way down. I had a net profit of nearly $1,000 over both plays. Over both plays. Make sense? Okay. Here's how it's done. I'm going to go ahead and show the structure, and it's different than a regular married put structure, and we're going to discuss why it's different. Mike, here the first time I played Altera, it was $27.35 to buy, and at the same time I picked up a put option that was 6 months away and in the money. So it looks pretty expensive, right?
Yeah, you're paying a lot of value for the intrinsic, and you're paying for some time premium also, aren't you?
That's right. My total invested amount here is $30.85 a share, and I've got a guaranteed exit of 29 because of that put option, right? I can exercise that put and get out at 29, regardless of where the stock goes. The stock could go to $10 or $5 or a penny, and I still get out for $29. Okay. Now, my total at risk is the difference between the $30.85 and the $29, or $1.85. Now, when you set that $1.85 against the $30.85, that's 6% at risk.
Yes.
6% of my investment at risk. Now, there's some what do you call objections to doing it this way. What are the objections?
Well, number one is that you're paying too much for the put option. You're paying too much for the insurance policy. The stock's at 27. You're paying 350. It's about 16, 17% that you're paying for this extra insurance. Number two, well, you're not going to make a dime, Kurt, until the stock goes up to $30.95. You've got a total investment now of $30.85, so you can't make a dime until the stock's trading at $30.95. Right.
Now, I just asked you for the common objections, and you gave them to me, okay? And neither one's correct, is it?
That's true.
Neither one's correct. I'm not paying too much for insurance, and I definitely can show you I'll make more than a dime, or I'll do better way before this gets to $30.95. Okay, let's take that first objection. The put option here is $3.50. Part of that's in the money, part of that's out of the money, right? Part of it's time value. Okay, so it's $1.65 in the money. See, $27.35 versus $29. It's $1.65 in the money. So $1.85 of it is time value. Let me point something out. There's 6 months between September and March. 6 or 7 months. What is that? October, November, December, January, February, March, 6 months, right?
Yes, that's right.
There's 6 months, and effectively, I'm paying $1.85 for 6 months of protection, or about 31 cents per month.
Mm-hmm.
Mike, if I bought a $29 put option 1 month away, would it cost me 31 cents?
No, it's going to cost you a little bit more than that. It has to be priced by itself, of course, at that time value difference, but then there's still probably going to be some additional time premium, maybe 50 cents, 60 cents, and so forth.
Right. Okay. Okay, so what I'm doing is I'm spending very little per month, and I don't have any intention of letting that stock go holding that stock all the way till March. Don't have any intention of that. Okay. All right. Now, I think we've already talked about this. I'm going to go ahead and show it again. The first play was between these points here, about 7 weeks in time. Okay. And the stock went up 17.3%. I only made 12%. Okay, during that time frame. Now, Mike, the second time that I played it, I was looking at this double bottom and yada yada. Sometimes I like to pretend I'm a chartist. I really can't predict the future. But here's what happened. She went down. Okay, and in fact, it could have gone down this far, and I still would have only had at risk 5.6%. Okay, the second time that I played it. It was a very similar setup the second time. Okay, all right, so. By the way, Mike, in these two plays, all right, just before I show some income methods, okay, can you pick out the patsy sitting at this table? Who's the patsy? Is it the seller of the stock? Is it the person that sold the stock?
No, not necessarily.
No. Let's say he sold short. He sold short. And he held that position for as long as me. So while the stock is going up, he's losing 17.3%. But when he does it again, the stock goes down 31%. That's how much he makes. Okay, so the seller of the stock, even if he's selling short, did not lose in this transaction. Okay, was it me? Did I lose in this transaction?
No, you made profit on the first leg, and then on the second leg, your long stock did decline, but you had an insurance policy in place, so you couldn't risk more than that 5 or 6%.
How about the guy that sold me the put?
Not necessarily, no.
Oh, he got on the hook. Here's why. See, the person that sold me the puts the first time won because those puts ended up going down in value. The stock goes up, the puts go down in value. But the second time, the guy that sold me the put, he ended up on the hook. I mean, if the stock went down 31%, let's go back here. This Altera was trading in I think the $50 range. It was really close to $50. Now it hasn't recovered very much above about 32. Yesterday I looked and it was still around 32. It was still around here. Okay, so whoever sold me that put, now he was the patsy. He was the guy that ended up on the hook.
Right.
Okay, and I'm not telling everybody, hey, look, selling puts is a bad strategy. I'm just saying, look, you need to structure it right. Okay.
Yeah, well, keep in mind. Yeah, keep in mind on the first leg, he wasn't going to make any. The person who sold the put wasn't going to make anywhere near 12 or 17%. They were going to make 2 or 3% on that upside, and then lose the 31% on the downside.
Exactly. So, ouch. Ouch. Well, I don't have a lot of sympathy because I know that there's a lot of books out there that will promote selling puts, and there's courses and there's gurus that will tell you, look, this is what you need to do. When what they should be doing is saying that puts is part of a total strategy. Okay, I'm going to show you a put option here, play in just a minute. But let's just plug something into the trade simulator. Okay, I'm going to get out of here, jump over onto radioactive trading page. Here's one of my bulletproof trades right now. I'm going to need to sign out in order to get into resources. Okay. Now, the trade simulator tool is not a means of predicting the future, is it, Mike?
No, not at all. That's not what this tool is doing. It's not predicting the future or predicting wins and losses.
Right. What we can do with this tool is we can say, okay, if you made a habit of trading a certain way, what are your likelihood of winning? Let's say that we made the 17.3% on the way up and lost the 21.8 on the way down. What would that look like after 100 trades? Okay?
That's not going to be
That,
pretty.
you know, coin flip here. Oh, yeah, no. Okay, so this time here, 2280. Starting with $10,000, we end up with 2280. That's not good. And that's winning more often than you lose.
Right.
Let's try it again. Boom. Oh, this time we went bankrupt after 45 trades. Let's try it again. Pow, went bankrupt after 52 trades. Let's try it. Hey, this time we were right a lot more often than we were wrong, and look what happened. We still got hurt. Okay, let's plug in the 12% target return and the 6% loss limit, and now see what happens. Mike, I don't understand. I'm wrong more often than I'm right here. Look at this.
It's a bad trading record.
50. Yeah, as far as picking winners, I only picked winners 42% of the time. 4 out of 10 times won, but then we took $10,000 and rolled it up to $32,000. You know, what's interesting is you skew your risk and reward. What's interesting is that you can actually lose more often than you win and still make money, still make good money. Okay, and I've been proving this in my pool account, and I've been proving it, demonstrating with you know, real money, and also with virtual trades, and also with students. You know, converts, that you can be wrong more often than right and still make money. It's kind of cool. Kind of cool. Okay? All right, so let's get back into this. I want to ask how this changes things for people. Okay? What does this mean to you? After we plug in the Trade Simulator tool, what does that mean to you? If you had kept your wins from last year, but your losses were reduced from whatever they were to 6% or less, what would that have done for your trading record? Would you have had a great year? Did you say disappointed before, but you would do much better? Or can you honestly look me in the eye and say, you know what, I really worked hard, and I did limit my losses to 6% or less, and I still didn't do well last year? Alrighty, that list is populating right now. I'm going to leave it up there for about another 30 seconds, and while we leave it up there, Mike, have we had a couple of questions come in? I've got 2 real good income methods to share, 2 real good things to share after this. They're riskless spread trades. So I know we got a lot of spread traders, but I wonder if we've had any questions come up. Okay, let me go ahead and close this poll and share the results. I'll give it another 3 seconds, 2 seconds, 1 second, and close. Bam. Okay. All right. You back there, Mike? I think you checked out for a little bit.
That's right, Kurt. I'm here. Sorry about that.
Okay, no big deal. I was wondering if some questions had come through while you're looking through there. I'm going to mention, I'm going to go over these results. Okay, 64% would have said, I had a great year. How does that compare with before? Let me see. How's that working out for you? We had 12% say, great, 12 months of gains. Okay, so is that 60-ish%, is that better than 12?
Absolutely, Kurt.
Yeah, okay. And then let's see, so 32% had said disappointed, but would have done much better. Very good. And Mike, 4% said, I did this. I never had a loss over 6%, but I still lost overall. Now remember the way that I structured that question. The question was, did you, if you kept your wins from last year and you never had a loss more than 6%, what does that tell us about these, this 4%? They didn't have big enough gains last year, right?
That's right.
That would be the only thing. The only thing. I mean, if you really were a fanatic and kept your losses down, 94% of the audience would have done great. I'm sorry, 96%. But the 4%, you are not letting your winners run. And I'm going to say that it's probably one of three things. Number one, you may be doing cover calls or naked puts, which limit your upside that you can make. Number two, and probably very likely, you are swing trading. You're not leaving enough time for an open-ended investment to develop. And both of those can be solved. Both of those can be solved by adopting the strategy of leaving your leaving your upside open. Okay?
Mm-hmm.
All right. So 96% going to do would have done great last year. Okay? So did that change things for them, I think? Yeah?
Yeah, looks like it did, Kurt. Mm-hmm.
Okay. All right. So here we are with Altera shares. I'm not sure why I'm putting that up there. Hang on just a second. Oh, yeah. Remember the structure of this? We had some objections before, and I'm going to go ahead and handle those objections now. The objection was, well, look at that put. Look how much you're spending for that. And Mike, I couldn't make a dime until what?
The stock hit $30.95, Kurt. Mm-hmm.
That's right. Folks are saying, hey, if you look at that, and Mike, you said that to me too, years ago when I first showed you the structure, you weren't really on board. Now you are, but back then it was, gosh, what did you tell me exactly?
I said, Kurt, I don't see how you're going to make any money on this position with this setup. I understand that you're limiting risk, but I don't see how you're going to make a profit here because you need such a large increase in the stock. You might be better off just doing a standard collar or just buying a 1 month output instead.
Right, that's right. Okay, well, Mike, here's how this one went down. All right, the total invested is $30.85, and what most folks do is they look at that and say you can't make a dime until the stock is at $30.95, and I'm going to go ahead and dispute that. Okay, you can't make a dime until Altera makes it from its present price of $27.35 all the way to $30.95. Not so. Let's take a look at this. The income methods from the blueprint will show you how to take the gap between the bottom level of what you could lose and the break-even and then reduce it. Okay? We're going to reduce that gap by taking a credit. And the first one that I'm going to show right now, I'm going to show how to do this without selling a call. This particular deal was bulletproof way before it got to $30.85. Okay, and Mike, when the stock goes up, what happens to the put options?
Well, it's going to decline in price, Kurt, isn't it?
Right, but let's not forget they all decline in price, not just the ones that are far away, but the ones that are near in as well. Okay, so when Altera went to $29.40. Well below that so-called break-even price of $30.85. Okay, it's possible for me to take a credit and leave the upside open, and this is what we call income method number 3, or the bulletproof vest. On October 15th, I took that $29 put option that was purchased in the setup and sold it. Now, Mike, if I sell my put, what happens to the stock?
Well, if you're going to sell your put, now it's unprotected, of course. Knowing you, if you sell the put and close that out, it's going to fall in price, isn't it?
The timing-wise, right? Yeah. But here's the thing. I never want to be unprotected, okay? So I did sell the put, but in its place I bought another one. Okay, so again, this is October, so I'm selling that March $29 put, and I'm buying a November $30 put. And here's why. I'll go ahead and tell you why. Altera was heading up, and I thought it was going to continue heading up, but it was going into an earnings announcement. And rather than have that $1.85 on the table, okay, I decided that I wanted to take away all of my risk. Okay, so Mike, does this look like a credit spread or a debit spread? This is a spread trade when you sell one option and buy another, right?
Yeah, if I just look at it straight in that fashion, if I ignore that I'm selling to close one and buying to open the other one, if I'm selling one and buying one, we would consider that to be a spread trade.
Okay, and it's done at a credit. Okay. Now, the fact is that I'm doing this play, which normally would be very dangerous. It would normally be dangerous for me to to sell a put option way out there and buy a put option close in. That would be really weird. Okay. But I'm doing this in the context of already owning the put and also owning the stock. So I'm taking a 90-cent credit. And in case you didn't catch that, we raised the payout by $1. I'm getting paid to raise the payout by $1. Okay, so this is what we call income method number 3. Now, I'm taking advantage of a phenomenon that I observed back in 2002, and I wrote about it back then when I was doing it with eBay. I had bought eBay and also bought a put option, and I saw eBay just climbing up like crazy, and I thought, man, I want to sell a covered call, and I thought, wait a minute, if I sell a covered call, then I can't participate in the upside. But then I also wanted to take some money now to kind of, take some risk out of it. And so guess what? I did this. And, some folks wrote in, and the blueprint actually was written because of this play. Because of this play, the folks that I was blogging to and that were following my blog, they asked me, man, you've got to write a book. This was awesome. Okay, so here's the deal. Here's this phenomenon. The put's price over on the left, how much is it?
On the left, the total put value was $350. That's what you originally paid up front for your put option, and was on September 14th, roughly.
Right. Okay. And here, about a month later, the stock has gone up, so the put option has gone down. Okay. And it's now trading at this point at $2.52. So that's what, a 98-cent loss?
That's right, Kurt. 98 cents down.
Okay. But in order for it to go down 98 cents, the stock had to go up by $2.
That's right.
So I'm okay. So I'm okay with that. I own the stock. I rob Peter and I pay Paul. Or actually, I get $2 in and spend 98 cents for that. Now check this out. We're going to just look at only the time value portion. Hey, the time value portion. Remember, the time value portion had been $1.85 of that 350, but now that put option is completely time value. It has increased. All right. Now, the cost basis for the stock and the put was $30.85. That's why everybody said, Kurt, you're not going to make a dime until your stock goes to $30.95. But here the stock is trading right around $29. It's trading right around $29, and so I did this play, take a credit for it, and get a new put option. Now, if it costs $30.85 for the stock and the put, and I take a 90-cent credit, now my new cost basis for the stock and my new put is $29.95, right?
That's right, yes.
Okay. Now you and I both know that I also did another income method. I'm leaving that out. The other income method captured even more credit, but I'm just doing this for simplicity. Okay. The November $30 put, I'm guaranteed to get $30 out of this, right?
That's right. You still have a guaranteed exit now of $30.
Okay, and the earnings announcement is going to happen November 4th, and the put expires third Friday in November, so afterwards. So going into this earning announcement, how much do I have at risk?
Well, now what's interesting is that we have a guaranteed, we have a negative at risk, I should say, or a guaranteed profit of 5 cents. Even if the stock collapsed to $1 per share, you are guaranteed to still make a profit now in this scenario.
That's right. They say I couldn't make a dime, but at least I made a nickel. See, the point is here, it's impossible for me to lose. And what did happen, the end of the story is that Altera did come out with very good earnings, and the price shot up to $33.10, which I sold at, and I ended up making 12%, holding it for about 7 weeks. But a large portion of the time that I was holding it, it was bulletproof. It could not possibly lose. Okay, so sitting at the table here, I was definitely, I was one of the players, Mike. I was not the patsy. Okay, kind of cool, and that's the deal. Okay, I want to teach more folks how to do these kinds of things. There's not just one, but there's 10 different income methods in the blueprint. Most of them are done at a credit. That's why we call them income methods. Okay. All of them change the risk so that it's more attractive.
Mm-hmm.
Okay. If we reduce the gap between the break even and our bottom line, what we can get out of it, to less than 0, then now we're bulletproof. And again, you have unlimited upside potential, but can't get hurt. We already showed how this is going to change a lot of folks' lives, right? With the simple question, and the simple question was, if you were able to keep all of your trades from last year, all of your winning trades from last year, and your losers only lost you 6%, would that make a difference to you? And 96% said yeah. 64% would have said it was a great year, and 32% had said that they were disappointed with their earnings last year, but this would have made the difference, right? Pretty cool. All right, now I've got another question, a follow-on, okay? If every spread trade that you did was heads I win, tails I can't lose, would you think that was pretty cool? If every spread trade that you did was heads I win, tails I can't lose, would you think that was pretty awesome? All right, we'll leave that up there for a little bit. So far, I don't have anybody saying I prefer risk that's bigger than a potential reward. This poll I may as well not have even done, right? But, oh, we got one person, maybe a wise guy coming in. I'd rather have more risk than reward. I'd rather lose more than I can possibly gain. And that makes sense. Okay, so let me go ahead and close that poll, Mike, and share the results. Okay. How about them apples? All right, now would it be cool? Do we have time that I can show this last income method?
Your choice, Kurt. We're already at 1:16.
We've got very good. I figured this particular webinar, this conspiracy theory groundbreaking webinar, just might go a few minutes over. Usually we'd like to be done in an hour and 15. It might be an hour and a half, okay? All right. And we are going to have a recording available for just a few days, but this is going to become a paid product. Everybody that's here today, thanks for coming. You know, you got in free, and then other folks are going to maybe have to jump through a hoop or two to get it, okay? All right, so let me go ahead and show this particular trade here. It's March, all right? And I'm buying Humana for $63.90, and at the same time, an August 2011 $65 put option, okay? Well, Mike, we've already gone through this where that becomes a total invested amount of $69.70 minus the put's strike price equals my risk. My risk is the difference between what I've put in and what I'm guaranteed that I can get out if I exercise my puts. Okay?
Yeah,
yes.
Kurt, I just wanted to mention.
Am I not sharing the? I got to hide it. I'm sorry.
Thank you, sir.
You betcha. Okay, so everybody see that? We've got Humana at $63.90, the August $65 put option at $5.80. Okay, so we end up with a total amount at risk of $470 for 6.7. I'm going to show you another way that you can make a stock bulletproof. Remember, this is scalable. Okay, instead of 200 shares, you could do 200 shares in 2 contracts, or 500 shares in 5 contracts, so on and so forth. No matter how big a fish you are playing this, you can still keep your risk to just 6.7% of whatever you are buying. Okay. Here I'm showing 200 shares in 2 contracts. Mike, do you see the dollar amount? Is it big enough?
Yes, that's right, Kurt. It's available there.
Okay. Is it big enough for everybody to read is what I'm wondering. The maximum risk. I'll go ahead and
I can read it, so I'm assuming everyone's seeing it almost exactly the same thing I'm seeing. Remember, I'm just viewing this as a regular attendee right now.
Okay, very good. So the maximum risk there is 940 because we've got 200 shares and 2 contracts. 940 is the maximum risk. Okay, now if I'm trading a $100,000 account, which I was at this time, okay, it would be about 1% of my account at risk, okay, and 6.7 of this trade at risk. So that's how that looks. Now, with that in place, that's being the structure, okay, let's mosey on up to another table and let's get acquainted with the players. Remember, we're going to rob the market maker of his edge. I really hate that there's that bid-ask spread, don't you, Mike?
Mm-hmm.
So we're going to take that away. Here are the players. There's covered call sellers. There's folks on the other side of that buying calls. And there's the market maker. And there's me. And all these players are necessary for this to happen. Okay? At this table, we're trading April calls. Remember, it's March, and I've got a stock and a put option clear out till August, but it's April calls that we're trading. Okay?
Mm-hmm.
Now, we've got the bid-ask on the April 67.50, 95 cents to sell, and $1.05 if I want to buy. And then the April $70 calls, they're 35 cents if I want to sell, and they're 45 cents if I want to buy.
Mm-hmm.
Okay? So here's what I'm going to do. I'm going to buy two at 45 cents, buy two of these April 70s, and sell two of these April 67.50s for 95 cents. So do I end up with, first of all, what play is that if I buy these and sell those?
Okay, well, if I'm, it looks like you're doing a bear call spread here, right, Kurt?
Yeah, it's a bear call spread. Now, the bear call spread normally has a certain amount of risk attached to it, doesn't it?
Of course it does. I mean, we're generating some premium up front, but we're risking the difference in the strike prices.
Right. So if I'm selling these two spreads at 50 cents a piece, the total cost for me is, well, it's a negative cost. I take in $100, okay? But what's the problem? The problem is...
Yeah, you still have a lot of risk there. You need the stock to stabilize 67.5 in order to keep that profit. If the stock moves up, you're risking much more than you can make.
Right. If the stock goes up to 70 or higher than 70, I'm going to have to pay back. I'm going to have to pay back the width of the spread. The width of the spread is $2.50, but I did two of them, so I'm going to have to pay back $5 or $500.
Mm-hmm.
Well, since I got $100 on the front end, that means that my total at-risk amount is $400. Okay,
Right.
so I'm taking in 100, but I may lose 400 by the end of the day. Okay, this is where we're at. Okay, so yeah, there's a little summary right there. I've got two 67.50 $70 bear call spreads generating 50 cents credit each. Taking $100, I'm risking 500. Okay, or actually a total of 400 because of the $100 in. All right, now the radioactive profit machine with 200 protected shares has got $940 at risk. We already looked at that, right?
Mm-hmm.
And here I am. I mosey up to the April call selling table or call buying table, and I do this bear call spread times 2 contracts. And so it has $400 at risk. So Mike, if I'm holding these two positions simultaneously, how much risk do I have? 940 plus 400 equals...
No, we might say 1340, but that's not the case, is it, Kurt?
No, it's not. No, it's not. Because what happens is this takes out all the risk of that, and that takes out some of the risk of this. It's really kind of cool. The duration of that bear call spread is just until April, so once it's over, it's over. But while I'm holding this, I want you to see how much risk I have in the bear call spread. Here we are looking at the stock price. If the stock price is at $67.50, I make money. If the stock price is at $70, that's the worst case scenario for the bear call spread, right?
That's exactly right. If it's trading above 70, the bear call spread, anywhere at 70 or above, you're realizing the full loss on the bear call spread.
Right. It'd be helpful if I explained to everybody, this chart represents all 4 legs. It represents me owning the stock, it represents me owning the put all the way out till August, and it represents me doing the bear call spread that expires in April. If the stock goes to $70, or if it goes to higher, Mike, I'm making money.
Mm-hmm.
So how does that bear call spread pose any risk at all to me?
Well, it doesn't. In fact, it lowers your risk, as we can see there, from 940 to only 840, and you still have an unlimited upside profit potential.
Bingo! How about that, cover call sellers? Would you like to be able to take in your credits month by month by month? Would you like to be able to take in your credits but not cap the upside? Would you like to be able to take risk away from owning stock and still have the upside potential intact? That's kind of cool. Okay, Mike, if this expires worthless, it didn't, by the way. It went against me, and I ended up doing another move and becoming completely bulletproof. Okay, so Humana is definitely bulletproof already. But Mike, if this expired less than $67.50, I'd keep my $100, right? My risk in the Mary put would be down to $840, and I could do it again, right?
Of course, yeah. The blueprint, of course, discusses if we had to adjust the short call maybe to hold the shares of stock, or as it moves up, what could you do to re-bracket the position or redo the position? Even if the stock's moving up, that's discussed. If it stays below 67.5, both calls expire worthless. We could do it again for the next month, or do one of the other income methods. Now, real quick, Kurt, I apologize. Robert wanted to know something. We didn't illustrate this up front, but what tools were you using to show those fantastic risk-reward charts?
I'm using the power option tools, and you can get a trial for those for free at www.poweropt.com/RAT for radioactive trading. I'm going to send that link out to everybody right now. I think it's kind of cool. All right. Now, Mike, let me wind her up here, okay? The edge of the market maker is usually 10 or 20 cents wide. We saw that just now with the, geez, you could sell the 70s at 35 cents, or you could buy the 70s at 45 cents. You know, it's 10 or 20 cents wide. Well, what have I done here but get myself a 50-cent edge, right? You got a 50-cent edge, and can do that more than once. You know, you can continue to do that. You know, if April expires worthless, then I go into May. If it doesn't expire worthless, it means I made money. That's kind of cool. Okay, so I'm going to ask, what are you going to do next? Now that we've shown all these things, okay, what are you going to do next? let me go ahead and ask the poll. And Mike, you sound like you want to bring up something.
Just real quick, while this poll is up, while you're answering this poll, one of our attendees had just sent in a question. It looked to me very briefly that the question said, does this work for ETFs? But as I was closing out one of the answered questions, that one came up, and I accidentally clicked the trash bin on that one as well by mistake. So yes, the RPM techniques can be overlain on top of a stock selection process you're already using. It can be used on the ETFs. Kurt has examples in the Fission track record, where he's made money on DIA, had a profitable RPM on DIA, SPY, I believe, and the Qs. That's her Qs now. Qs, what is it today? You know, you never know. So yes, this can be done on that, and we had a question come in earlier. This is discussed in the blueprint. I'm kind of giving a hint away, but there are a couple of methods. Well, a couple of our customers asked about, well, what do you do in a bearish market? This looks like it's bullish. Well, Kurt discusses how you could approach this limited risk idea in a bearish market. If I'm already in an RPM and the stock falls, there are income methods that can be used to adjust the position in a bearish market, but there are also ways that you can approach this bearishly. For example, well, maybe doing a standard RPM on an inverse ETF.
That's right. That's one of the three ways. There's three different ways to play this upside down, and two of them we recommend. One of them we don't. Okay, Mike, I'm going to go ahead and close this poll and share the results of that one. Okay, I actually didn't even promise this yet, but I have a different risk-free credit spread. We showed two risk-free credit spreads today, right? I'm going to send another risk-free credit spread to the folks that follow directions in the next 5 minutes, okay? The folks that follow directions in the next 5 minutes, you're going to get that, okay? And what was our winner here? I love the idea of bulletproofing. 8 out of 10 of our viewers said that made a difference to them.
And what were some of your early detractors, Kurt, when you brought up the idea of bulletproofing? You said, "Oh, well, I can do the same thing by doing covered calls. If I sell calls month by month, I'll be able to pay for the cost of my stock." How long is that going to take you? 2 years? Maybe. 5 years if you're trading a $60 stock, perhaps? I mean, what about 2 months? What about 1 month, for example? Now, that's not always going to happen, but we have examples. Kurt has examples in Fission, and we've shown examples that I've done in my account where we were bulletproof in the first maybe 30 to 45 days.
Right. One of your best trades from last year, Mike, was you were bulletproof in a month, and then after that held it for another 4 or 5 months. Ended up with a 59.8% return. Not bad for a bulletproof stock. Something you can't lose on, and then you make nearly 60% on. Oh, wait, Mike, I'm going to ask folks, hey, what do you think you ought to do next? Do you think you ought to get the blueprint? Do you think you ought to get more free stuff, or would you like to do both? All right, get the blueprint, get more free stuff for both of you. But by the way, this is our final poll, so I just wanted to put that out there, and I've got a couple of directions to give you, and then we'll be done. All right. So thanks for sticking around, everybody. We've got more than 200 of you. And I'm very pleased to have the opportunity to make a difference in anybody's trading. I know that I would have liked to have had this 10 years ago when I first got started.
Got a comment from Robert that came in, a question. I should say, how complex is it to do and follow the income methods? Well, it might be something new for you to look at. You know, Robert, if you've been trading options, you know sort of the basics that are already in the income methods. It's just you probably haven't looked at it this way to see how it works in the context of these types of positions, just as we saw with bear call credit spread. Done in the context of this, that doesn't increase your risk. It actually lowers your risk and leaves the upside open. It's very unique with that particular income method and the other ones as well. But keep in mind, and this also reverts to Stanley's question that came in, is that he already owns the blueprint. Well, for anyone who buys the blueprint, for anyone who already has the blueprint, for example, you want to take advantage of your free resources. If you have questions, send us an email to support@radioactivetrading.com. Give us a call during the day, and we can walk you through some steps and answer some questions for you as well.
That's right. We want to always talk with folks that are wanting to be part of the conversation. Folks, here's the deal. I want you to copy this down, okay, for the free stuff. The free video, the free riskless spread trade video that I said that I would make available, a different riskless spread trade. You're going to copy this down. Put, in all caps, put the word testimonial in the subject line of an email with your biggest aha moment from today, and put it in an email to me at kurt@radioactivetrading.com, okay? Your biggest aha moment, all right? The next 10 letters are going to definitely get a video. We may even extend it beyond that, but the first 10 letters are going to get that video, okay? Again, copy this down for free stuff. You put testimonial in the subject line of an email with your biggest aha moment from today to kurt@radioactivetrading.com. First 10 letters will get a free video. We may even be able to give a couple more things out.
And it shouldn't be take on me. That should not be your biggest aha moment from today.
All right, 80s joke there. All right, and then your exclusive free video is going to include a spread trade that's done at a credit. This spread also has zero risk. Now, if it's done normally, it has infinite risk. Okay, but if it's done in the context that we show it, it's going to have zero risk. It can be done in an IRA. Okay, Mr. Brasher. Remember, John Brasher said it's the only one that cover calls is the only thing you can do in an IRA, which isn't so. Your exclusive free video is going to also have, yeah, you can qualify to do it. If you can do cover calls, you can definitely do this. It pays you to open this spread trade, and it may pay you again when you close it. It pays you to open it. You get paid on the front end, and you may get paid again when you close it. Really interesting spread trade. First 10 letters are going to get that video, so get working there, guys. If you want something free, well, it's gonna take you a little hoop jumping. Okay. All right. Now here's another thing to copy down for free stuff. We already did that. Iridium. Okay. Write this down. IRIDIUM. Iridium, that's one of the chemical elements, okay? Put iridium in the subject line of an email with your biggest reason for or your biggest objection to getting the blueprint right now, okay? Put iridium in the subject line of an email with your biggest reason for or biggest objection to getting the blueprint right now. And by the way, if you already own the blueprint, you can still participate in this by just writing a testimonial, okay? If you already own the blueprint and you're happy with it, write a testimonial. If you own the blueprint and you're not happy with it, well, guess what? It does have a money-back guarantee, so go ahead and send it back. But the first 10 letters are going to be guaranteed some bonuses, and I'm not going to tell you what these bonuses are at this time, but I will say that they're worth over $300. Okay, the first 10 letters to put iridium in the subject line of an email with your biggest reason for or your biggest objection to getting the blueprint right now, you're going to be guaranteed a bonus. First 10 letters. Got it?
Mm-hmm.
Okay. Those bonus materials are available on a available basis only. First 10 buyers are guaranteed it. Others may also get it, but it's going to be space available. Okay, it just depends how many of those special CDs and other things that Greg has got laid up at the office. Okay, Mike, I am done.
Yeah, just remind everyone what Kurt was referring to. Yeah, just send an email to support@Radioactive Trading with those text links there, that message is there, the testimonial or the I apologize, the testimonial comment there, or the what was the other one you wanted to? Iridium. Oh, I apologize.
Iridium. Yep.
IRIDIUM. Mm-hmm.
This is for free stuff to guys that are really seriously considering getting the blueprint. Okay, I will guarantee that you get this with your blueprint if you copy down Iridium and tell me your biggest reason for or biggest objection to getting the blueprint.
Mm-hmm.
And a testimonial, your biggest aha moment from today. Okay, if you give me your biggest aha moment from today, and I'll make sure that you get that video with the free spread trade. I'm sorry, with the spread trade that's done at a credit, has zero risk, can be done in an IRA. You can qualify to do it if you are simply qualified to trade cover calls. It pays you to open it. It may pay you again when you close it. And the first 10 letters will get this video.
Mm-hmm.
Okay? All right, cool. That's all I'm asking today. I'm not even going to do a sales job.
Okay.
So, Mike, thanks for coming. And I hope I didn't offend too many people talking about patsies and conspiracies and all kinds of other things. We'll see you out there. I hope that we are able to keep this up for a week, but we're going to probably take it down after that. So, Mike, thanks for coming. We'll see you out there, okay?
Yeah, ladies and gentlemen, I know that there are a few questions that didn't get answered, and I lost track of some. We also had one of the other customer service reps, Greg, was here answering some questions earlier, and I'm not sure I couldn't tell which ones he answered or which ones he didn't answer, which ones maybe double answered. Well, we have a record of all the questions that were asked on the presentation, and we'll be answering those later this afternoon, one by one as we go through. So your questions will be answered even if I didn't get a chance to answer them during the presentation.
Very cool. Very cool.